Today is October 14th, and this is the ADM Investor Services Weekly Market Wrap-Up. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Alan Bush, the Senior Financial Economist at ADMIS, and Steve Freed, ADMIS's Vice President of Grain Research. Steve, let's start with the grain markets. What did this week's USDA crop supply and demand report say?
Well, pretty much the numbers were in line with the average trade guess, and they raised the bean crop, lowered the corn crop a little bit. Carryouts are still bigger than last year. The only big surprise was they added to the world soybean carryout. And it's interesting in that we were down the day of the report, and then now we've rallied ever since then. The lows were about 9.37 in November beans. Today we're trading as high as 9.73. Corn was down to 3.36. And we're now trading at 3.55, and the low in the wheat was about 3.80, 3.70, and now we're at 3.96. And it's interesting in that if we trade above today's high, technically speaking, we go to 9.94 in the beans, 3.80 in the corn, and 4.44 in the wheat.
So a little bit of a breakout technically could lead to maybe some more buying, maybe some short covering from shorts.
Yeah, in the wheat, the market is concerned about global quality. It's also talking about a little bit of pickup in demand, and that farmers may plant less wheat acres next year. And so we had a short covering, and the funds were record short before the report. Over the corn, the farmer's just not selling enough, and we got to find a price in which he's willing to fill the pipeline, or we continue to work higher. And the funds are also close to a record short in corn. And over the beans, I think they're just buying it because of the demand.
Which actually plays right into my next question. Will this rally in grain prices bring the farmers to the market, to the elevator market now?
You know, it's interesting in that we have the same theme since the start of harvest. Prices are good for soybeans, yields are good, better than expected, and so the farmer is selling beans right off the combine. He's storing the corn, thinking that because of the strong carry that we have in the market until next spring and next fall, he's going to wait to sell the corn until a later date. And so right now he's on this theme of sell beans to pay the bills and store the corn. USDA also, in a crop insurance move, sent $7 billion to the farmers this week in crop insurance for the drop in prices. And that'll help farmers kind of get through the current situation and may slow some of their farmer selling.
Looking at our competitors in South America, the planting season is beginning. What is the early outlook for the South American 2017 crops?
Well, I think the USDA is calling for a rebound in production, especially in soybeans. They're off to a good start. The weather is normal. You have to worry about weather forecasts because last year everybody focused on El Niño so much they missed the good weather over most of the world. But right now they're talking about normal weather in South America, which means it should be good crops and negative to prices.
In addition to weather in South America over the past year, 2 years, they've had infrastructure issues, they've had port issues, they've had governmental issues and with changes in regimes, things like that. Do you see more of that playing into grain prices, South American grain prices, and the crops in general there?
Well, on one hand, both Brazil and Argentina rely heavily on exports to pay their bills. So they're going to do anything they can to get and keep market share. Obviously in Brazil, with their economy the way it is, their whole situation is like a house of cards. And you just don't know, from an agricultural standpoint, they'll continue to grow. But from an economic standpoint, they're stumbling. In Argentina, a lot of it has to do with the perception that the new regime was going to improve the economy. And right now they have some export tax situation, especially on the soybeans. And so, it favors corn and wheat to be planted versus soybeans, which is kind of contrary to world prices. So we'll see. Argentina is trying to take steps forward in their new government.
Alan, turning toward the financial markets, the U.S. dollar advanced to new 11-week highs this week. What is behind this strength, and do you feel it will continue?
Well, first of all, the main reason for dollar gains is the interest rate differential expectations that have been very favorable, in fact have been getting more favorable to the US dollar index. Now, the Fed is on track, at least according to the financial futures markets, to raise rates at the December meeting. In fact, the latest reading shows that there's a 74% probability that the Fed will raise at the end of the year. So it's entirely interest rate driven. We feel that the dollar will probably continue to advance, although we still think that the Fed may be a bit slow to raise rates. But keep in mind, the Fed is the only major central bank that will raise rates either this year or next year. So that is the dominant bullish influence that will take the dollar higher through the balance of this year, and I would think well into next year.
So despite little market reaction to the release of the minutes from the September 20th, 21st FOMC meeting, the majority view remains that the Fed will increase in December.
Right, that's very much the majority view. I'm not quite so sure that they'll raise then, maybe next year. So the Fed is on track to raise rates sooner or later, and I'm thinking more toward later than sooner.
So at this junction, I think that if they didn't raise rates in December, it would be more of a surprise. I mean, you said 74% probability.
Yes.
What would that do to the market?
Well, first of all, it would be very bullish for the stock index futures. Of course, we are bullish. The indices have been for a while. Even if the Fed does raise rates at the December meeting, a second rate increase is still not high enough to actually reverse this bull market. So I'm not really that concerned whether the Fed raises in December or next year. If they do at all, stock index futures will continue to advance. So that would be the main influence, I would think, on the indices. As far as the dollar index, if they delay a rate increase, all it means is that the dollar index will probably rise a bit more slowly.
Looking at the bond market, the 30-year bond in particular, futures fell to a 5-month low earlier this week. There was some recovery later in the week as new worries emerged that over the state of the global economy. Can you speak to this, and what is your outlook for the DEIS 30-year bond now?
The bonds still look like they're in trouble. Even today, we came under some pressure, even though we should have rallied on the very weak University of Michigan's Consumer Sentiment Index coming in at a 1-year low. That would be a very bullish factor for the bonds, and yet the bonds are 1 full point lower. So something is really wrong, I think, for this market to not respond to bullish news. Our thinking is that it's the inflation outlook that is becoming more and more of a negative on the bonds. And of course, we do have this 163.19 double bottom that I think will be taken out. So look for inflation to gradually increase, gradually accelerate, and that will be the main influence that takes the bonds lower longer term.
Finally, I guess I would ask both of you, what's hot and what's not out there in commodity land right now?
Well, let me start if you don't mind. Gold is not hot right now. It had been earlier this year. And the reason it's not hot is that traders, I think, were forced out of long positions with such an aggressive tone from Fed officials. I'm thinking that the Fed will not be able to be that aggressive. So if we're right in our inflation thinking, gold, while not hot right now, very soon will be to the upside.
It's interesting to note that the commodity funds have added $59 billion since the beginning of the year. And now we have more money in the market in commodities since 2009. So Alan's forecast of inflation seems to be coming into commodities. And so specific commodities are starting to make bottoms. And so they seem to be the markets where money is flowing into, led by the energy markets.
Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views and opinions of ADM Investor Services or Archer Daniels Midland Company. If you would like more information about the brokerage services offered at ADMIS or would like to open a trading account, please visit www.admis.com.